Now, I would like to invite Max. Please feel free to share your screen, Max.
Okay, yeah, so my name is Max Tesselaar. I'm a researcher at the Vrije Universiteit in Amsterdam. And I'll be presenting, well, for most of my academic career, I've been focusing on assessing insurance strategies for climate risks and kind of comparing the two main objectives of insurance, this type of public risk, which are solidarity and efficiency. And here I will, I apply a modeling framework for to assess these kinds of questions. And here I'll present some of my latest research, which is on inequality in access to flood insurance. Right, so. Okay, and this study was done for the government of Austria, so I have to be very careful. This is Austria, not Australia. The government is interested in reducing their very large insurance protection gap for a flood risk. And this is a riverine flood risk because this country doesn't have a coastline. So the flood risk in Austria is insured around 5-10% of the total risk is insured. There's also a public fund that compensates any damages, but this is very uncertain. So this deviates a lot depending on circumstances. So essentially they came with the question, well, how to reduce this very large insurance protection gap. And in this project, we assessed different strategies to do this, and in particular focusing on solidarity. So how do these different strategies deal with inequality also in prices, for example, but also in access to insurance. So here, very briefly, I plot the. So as I said, I apply also a modeling framework for this. So this combines a catastrophe model with an insurance sector model, and then also a model of human behavior, how people respond to different incentives. And here you can see insurance premiums under the different modeled insurance systems for 2010 and for two scenarios of 2080. And so very briefly in the left figure here, these show box plots. The most left one is a private system. So what if we kind of stimulate the development of a private insurance system in Austria where private insurers provide coverage against more or less risk-based premiums. And then we can see, focusing mainly on households that are exposed to floods, then we can see that premiums do become quite high. So here we can see a median in 2010 is around 2,500 euros annually. And we can see that under climate change, this increases, of course. So these are box plots because, of course, there's a lot of variation in the households that are located in floodplains. So we can see that this is, for many households, this is much more than 2,500 euros. Then, on the right of this figure, we can see, what if we introduce what if we improve flood protection standards? What then happens with flood risk and insurance premiums? And we can see that, in the short term, this kind of halves insurance premiums, but in the long term, this proves to be less effective also due to climate change, of course. Then on the right, we can see, what if we apply different insurance strategies? So here we can see a public system where, this is more or less a tax-based system where the entire national risk is divided by the number of households, essentially. Everybody pays the same amount. And of course, this is able to suppress premiums a lot because now the risk is shared amongst the entire population instead of just the population at risk of flooding. And then there's also a public-private system, and this is based on something that we see in the UK, where a government is involved in a reinsurance pool and sort of enforces a degree of cross-subsidization, of risk sharing. So there's a cap on the premium. So premiums can be risk-based within a certain margin. And of course, if we focus here on households exposed to floods, then yeah, everybody will pay the cap here, because we're focusing here only on the households that are located in floodplains. Yeah, so this system is quite successful, or can be very successful in combining the objectives of efficiency and solidarity, because you can see premiums remain more affordable, but there's also there can be a risk signal that is the main advantage of this risk-based system. Okay, but what if we focus then on inequality? So here I combine the premiums that we saw before in the same systems with quite detailed information on household incomes. And here I differentiate this also in low, middle, and high income households. And here this shows the premium as a percentage of income. And then, of course, you can see that in the private system with risk-based premiums, and then particularly for low-income households, premiums do become very expensive. So you can see, well, we saw this was 2,500 euros, the median premium, and you can see that this is around 11% of the income for low-income households. And this reduces, of course, for higher income households. Yeah, so we can see that probably for many, particularly low-income households, insurance would be unaffordable under this system, and under public system or a public-private system, this is much lower. So then the final slide, and I'm ignoring the figure on the left here, so I'm focusing on the figure on the right. This shows well, what is the insurance protection gap? What is the impact of the insurance protection gap for different income categories? And here we show the impact of a 100-year flood on as a percentage of household wealth for different insurance systems. And here the red box plots show the impact considering there's no insurance available. So well, there's no coverage of the risk. All the risk has to be paid for by households themselves. And then for low-income households, of course, this is very high. So for more than 50% of these households, they would pay, or well, the damage is 100% of their overall wealth. This is also the case for middle-income households, and lower for high-income households. So what if we introduce insurance, and particularly private insurance that is voluntary, so households can choose themselves whether to insure or not, and premiums are risk-based. That is the dark blue box plots here, and we can see that for low-income households, not that much changes. So actually for more than 50% of these households, all of their wealth is uncompensated and will be destroyed. For middle and high income households, they are much better able to take advantage of the availability of insurance and thereby reduce the impact of a flood, the uncompensated impact of a flood. So here we can see this kind of inequality in the access of insurance as a way to adapt to climate change. And then, well, public and public-private systems are much better able to provide insurance for all income categories, and mainly this is because insurance there is mandatory. So well, the insurance protection gap is forced to be closed in a way. Well, here we can see there's still a little bit of inequality, but that's because of the deductible as it was modeled here. So of course this is higher for relatively higher for low-income households. So essentially, yeah, to conclude, this study kind of makes a case for mandatory insurance and for a limited degree of risk reflective premiums. So we want premiums to kind of stimulate risk-conscious decision making, but it should be balanced and not lead to high degrees of unaffordability for low-income households. Thank you.